Coming to you from the Tar Heel State, this is the Carolina Commercial Real Estate Connection, bringing you industry insights and hot takes from Carolina real estate experts, helping you begin, grow, and scale your commercial real estate portfolio. And now your hosts, Tony Johnson and Cameron Pearson.
Thanks for joining us for another episode of Carolina Commercial Real Estate Connection. Today we have Hemal Badiani with us. Hemal, thank you so much for joining us.
Yeah, thank you for inviting me, man. I'm excited to speak with you and talk about all things commercial real estate and life.
Awesome. Hemal is in Charlotte, North Carolina, and one of the founders of Sage Equity. Hemal, could you give us a little background on what got you into commercial real estate and how long you've been in it?
Yeah, absolutely. Phenomenally interesting story, at least to me. So I came from India as a 19-year-old naive kid here to UNC Charlotte to study, then moved to London to chase then my girlfriend, now my wife of 20 years, got into management consulting there. Lived across 3 continents, and then eventually convinced my wife to move back to Charlotte after a few years. This was where my heart was, and I really believe it's a strategic place in terms of access to mountains and beach and growth and beautiful weather and airports and lifestyle and all things combined, right? So. And then, continued with my management consulting career for about 15 years, worked with everybody from Disney theme parks to the Vatican. So I had great clients. Imagine standing even as a 22-year-old in front of the CEOs and CFOs of multi-billion-dollar companies and telling them how they should run their things and get paid to do so. So that was a great job. And then had twin events also called twin babies, now almost 80-year-olds. So decided to hang up my traveling boots and transition to Wells Fargo. I was there as senior vice president of business strategy there for a few years. That was a much more cushy job with an assistant and banker's hours, and allowed me to change a few thousand diapers and get bored. And then I started thinking about what does it look like, right? What does it mean for me as I evolve in my life? What are my competencies? What do I like to do? And so 2 things I love, which are my superpowers, so to speak. I love finding people and inspiring them to realize their potential or highest potential beyond what they might think they believe in. And then I love scaling businesses and balancing that execution and generation of ideas. Most people either stay in the ideation phase or execution phase, and I like to do both. And so that led me to a journey of creating an outsourcing company, which I scaled and exited. Then I started my own private lending company to flippers here in Charlotte. Quickly realized they make more money than I do. I'm like, I need to learn this flipping thing and wholesaling. So 2019, I started a wholesaling flipping business and scaled that and exited in just 2 months before COVID hit, and graduated into the commercial world right in the heart of COVID. Started this company called Exponential Equity, which we now rebranded to Sage Equity. And what it looks like right now, we have 4 divisions of the company, 3 partners, 13 people. We have a land entitlement and rezoning division. We have a construction new development arm, essentially. We have existing multifamily acquisitions, and we bought last year EB5 regional center, which is essentially a foreign funds investment company as well.
Wow, that's a ton to package here. I'm trying to keep up with the notes. You have so much for me to keep up with and dive in on a little bit. So you were with Wells Fargo, got out of that, started an outsourcing company, and from there you exited that and then started lending. When you were lending, were you lending to just single family flippers? Is that what you were lending to?
Yep. I got some of my own funds, some of friends and family funds, and that debt looked attractive at that 10, 12 points plus 2 points in and out, and so that was a good gig. But realize that to make money at that scale, you need to have money at scale, which we now raise. We raised since inception of Exponential Sage, we've raised $43 million in the last 3 years. And so now our ability to raise is different. Back then it was just friends and family conversation. Hey, I'm putting $1 million. Would you like to put a couple of 100,000 type of deal?
Absolutely. So, well, let's dive in on that a little bit. So raising 43 million, that's quite a bit to raise. Is that just between you and your two partners you've raised that much?
No, so the way our company is structured, first of all, is, if you think about, the E-Myth and the triumvirate of roles that are at the spearhead of a company, right? You have the acquisitions arm, you have the operational arm, and you have the growth arm, right? And so Brandon leads all our acquisitions on the land acquisition side, especially some of the construction sites that we acquire. Yomesh leads all our operations, so all the property management, asset management elements, all the legal, vendor stuff, cracking the whip, maximizing our spread, and minimizing our cost, the accounting side, all of that. And I get to shake hands and kiss babies, right? I'm the growth guy, so I do the marketing.
This is the toughest part. The growth is the toughest part.
Toughest part. I tell them every day. They don't believe me. But yeah, so I'm the new ideas guy. I do the marketing for the company. I handle the investor relations and the debt and equity side of the conversation. So all my relations with lenders and all my relations with pref equity and capital partners and our investors, which we have about 750 of those. So out of the 43 million, I would say it's about 50% is our investors. Most of them are repeat investors, average deal with us 5 times. So we enjoy incredible credibility. But then, we rely on other capital partners and pref equity in a couple of instances to complete the capital stack.
Okay, just for people that aren't so familiar as you're going through that. So just to kind of clarify a little bit and break it down for people that are newer to raising or not even understanding raising. So what you've done is set up a 506c fund basically for you guys to raise. And so that's where you have your 750 investors that you can, with a 706c, you can kind of publicly advertise for investors and get accredited investors, right?
Correct. Most of our deals are 506c, couple of them that are smaller, which we just go to our investors that we have a pre-existing relationship with. There's other category, if your investors don't know, 506b, which allows for non-accredited investors to come in, but we have to have an existing relationship. We cannot advertise. So we have deals like that as well. We have joint venture deals where we just get a single check. Somebody's looking to park their funds out of 1031 or IRA money, and we're buying a piece of land. We just do a joint venture project with them as well. So we raise funds in multiple ways, depending on the size of the check and the type of deal we're trying to raise for.
Awesome. Thank you so much for that. Then the other aspect that you mentioned was pref equity, which that is, I'm assuming, private equity firms. Am I right on that? So you're basically in that circumstance partnering with a larger firm that has a larger stack that you go and basically are able to just do one person and get a significant amount of money.
Correct. And the one ratio that in banks and in real estate, one you should look at is the weighted average cost of capital, WACC, right? So, if I'm getting my 60% of my lending at 6%, then another 10-15% at 10%, and then I have my common equity investors that are going to get 7-8% pref and upside in the profit sharing, et cetera, the 70 or 80% of my part of the capital that I'm raising now came in 10% or under. So if you average that out, it's around 7%. So that allows us to optimize the deal, the cash flow of the project, because you don't want everything to be at a very high interest rate, right? So that's where such pref equity comes. Typically for larger deals, we don't like to leverage to 80-90%, but if we are at 70-75%, a bank is coming in at a very attractive debt option for 60-65%, and we want to plug in another 10% in a pref equity position, and it allows us to bring that overall average interest rate down, and that allows us to make better returns for our investors and ourselves.
And that's a sophisticated way of doing business, right? So
Yeah.
newer people, you have to understand this breakdown. When you're able to look at it from this facet, this is how you can make deals work, where you might just look at, a hard money lender for somebody that's newer, or just looking at one avenue and not really creating a sophisticated capital stack where you can actually maximize those returns for yourself and investors. And understanding how to put all that together really makes a huge difference in one, making a deal work, and two, you guys making money for yourself and your investors.
Yep, absolutely. And that's why we bought that foreign funds company, where, essentially for construction projects, any funds we raise through that foreign funds company, we typically have to pay 2 to 5% to those investors, and no upside. So that's another capital stack for us. Even if we get 10-15% of a construction project raised through that, that allows us now to lessen the interest overall, and maximize profitability. So we try and find, in this market, you can either be there's two ways to earning money, right? The headwinds are there for macroeconomics, going into that a little bit. Things can be sideways for the next few years, given the interest rates, given the delinquencies and things that are happening. There's two ways to earning money, in my opinion. One way is to be that turnaround god, operational maximizer, where you might have an eye for finding distressed things that are really distressed, that through your vertical integration, having painting and drywalling and property management experts within your team, and control of supply chain and things like that, which something might cost $8,000 to run, now is $5,000 per unit. And that's where you create the spread to make sure that any mistakes that come in, or any changes in the macroeconomic environment, you're still making money. So that's one aspect. The other aspect is to find deals that are just above average, or types of transactions that are just above average in terms of the spread itself. So for us, land is that kind of business that allows us to make 2x, 3x in terms of land. And then the third thing is to reduce your overall interest that you're paying overall, so that then the same deal that might generate 15% returns for someone else could generate 20-25% returns for you and your investor, and that makes it an attractive deal. So those are the three ways we see playing. We are not playing too much into the vertical integration, the operational turnaround expert type of thing. We want to play in finding great, attractive, high above average deals that make incredible spreads for our investors and us, and then also finding ways to reduce the cost of capital, so to speak. So that's through lending relationships, line of credit, buying companies like the ones we bought, partnerships with these institutional players that can come in at a cheaper rate for us. All of that combined with our high spread kind of projects will allow us to make money over the next 3 years, rather than doing average type of deals.
It's interesting. So when you're saying, you're saying that when you're going and dealing with the private equity firms, are you saying you're able to negotiate better terms with them in some circumstances than the bank, or better circumstances than individual investors?
Better than individual investors. They're not going to be as cheap as the bank, right?
Okay. So
but as performance, they look at our performance, They look at our past track record, and they're, if they're giving someone a 14% interest, we can negotiate 11% interest.
I see.
And that allows us, and we can also negotiate, hey, you don't get to keep the depreciation, bonus depreciation on existing asset. We will keep that part of yours for that $2 million that you're bringing to the table. So now we can distribute that to our investors and get them more tax benefits, all things being equal. So there are negotiation points that we do from that perspective, how much they earn during the project, how much they earn at the exit. That's another negotiation lever. So we can go down the rabbit hole on private equity, man.
Well, no, that's very important, is understanding all those concepts. Anybody that's newer to this, I mean, you look at private equity, and a lot of them, people are, well, these guys are just going to run over me because they're humongous. So you are speaking, right? So understanding how to negotiate that, one, being able to negotiate that, two, is also extremely important to where you can then make this work. So that's amazing. I would like to dig in a little bit on the EB5. So you said you purchased an EB5 business. Could you kind of run us through that? And I guess before you go into that, will you explain to those who don't know what EB5 is?
Yeah, absolutely. EB5 is a job creation program run by the US government since the 80s. Essentially for investors that are outside of the United States, or families that are even in the US that are on any type of non-immigrant visa, right? Like a work permit or a student visa, etc. If you can invest $800,000 into an EB5 qualified construction project, simplistically, there are other types of projects you can do, infrastructure, businesses that are negative, etc., etc. But for us, it's construction projects. Then you and your family, as part of the application for investing in the US, $800,000, and creating 10 jobs through that mechanism that we have to prove those 10 jobs created, then you and your family get a green card in a few years. So it's the golden visa equivalent of United States that is, there in almost all great countries out there, right? So it's a pathway to immigration. So what it does, it's a win-win-win situation. The US government gets job created, more inflows of US dollars coming in from other countries. The investor, obviously the whole family, gets to self-sponsor their permanent residency in the United States, which doesn't happen in almost all other visa categories. And it's also sometimes the fastest way of getting a green card that most of the people won't get it, right? So a permanent residency, people who are US citizens or residents already may not know, but it creates a lot of benefits, right? You're paying in-state tuition. If you're on a work visa right now, if you get fired from your job in 60 days, if you don't find another job, you have to pack your bags and leave. So there's a lot of swords hanging over you for 15, 20 years sometimes, because the backlog of the US work visa and permits are so high. So this allows you to take that sword away from your family, right? And invest in the US. And for developers like ourselves, it's the cheapest capital stack out there, because essentially they're not investing for making money. They're investing in a project where their capital is preserved, because they have to sign that the entire capital they invest is at risk. And they'll be at risk till they get their green card, which is several years typically. And so for us, if we have a qualified construction project, just like a private equity stack, we get the senior loan 60-70%, we get 10 to 20% of EB5 money, and then the rest comes from our retail common equity investors. So now we have 2 to 5% interest rate that we're giving someone for giving us an $800,000 check at a pop. You get 5 of those investors, that's $4 million that is now coming in at a very cheap rate for us. So what we did was, essentially did a vertical integration. For most part, if you want to obtain this visa, you have to go through what is known as a regional center, which is an affiliate of the US government that has been approved by the US government to be the fund manager to collect all this, report on the jobs that have been created, do some compliance, et cetera, for several years. And so we bought that business. So now we are both the developers and that fund management business, where in the Carolinas, if anyone is looking to invest, they'll pick one of two companies that are here, and we are one of them, right? So they have to come through us for other projects that are not part of our partnership, but also then, for us, we can show that, hey, this is our project, it's 506c, we're raising common equity, but we're also raising EB5 money from Latin America, Asia, wherever the funds can come from. And, you have to go through each country's legal stuff, immigration stuff. There's a whole bunch of laws and hoops that I won't talk about that gets it complex, but it's cheap money.
Awesome. And that's so interesting. So when you say you're one of two companies, are you saying that you're one of, do you also help others who want to get into doing EB5? Is that what yours does? Or you can potentially use your company that does the EB5 to invest in other development projects, even if you're not involved in the development itself?
Yeah, technically we can. We like to, because if you do that, then as the EB5 company, we would carry a significant liability if the project fails. So we don't like to advertise that way. Some centers are, across the US, they just do that, is give me 2-3 points of arbitrage, and you run the project, we'll bring the investors, and we're done, right?
And then it would just be like a larger, what you were doing in the beginning when you were doing debt for fix and flips, right?
Yeah, exactly.
Just creating and making the money on the arbitrage. Exactly. But what you guys focus on doing is doing it vertically integrated, as you said, in-house. So you're putting the EB5. So when you're saying that you're doing the EB5, do the people that are trying to get the citizenship actually get in contact with you, and Correct. You guys hold them through the whole process, document the job creation, document everything for that 2-3 year period, whatever it is, and Correct. Get them all the way through to get the green card?
Correct.
Oh, so this is amazing. So you guys are not only doing something where you're making money for your investors, you're also helping these people be able to get citizenship, right?
Absolutely. Absolutely.
As you said in the very beginning, this is a win-win-win. So you're winning for the country, you're bringing money into the country, you're helping people that want to stay here. And these are probably the best of the best people, right? That are coming in. I mean, these are the type of people that we want to become citizens, right?
Exactly. Exactly. And US government has so much rules and regulation. Like even when they come in here, they get a temporary green card, then they have to stay in for 2 years, not even get a parking ticket. And that's when they get the permanent green card, and that's when they can get their money back. So it's a very long process for them to prove that they're going to be good citizens or permanent residents of the United States. And so these are the type of people we want to attract, right? Who are entrepreneurial in spirit, they have the net worth, are adding to the economy from the get-go, et cetera. So our company, if you want to have more information, it's called EB5help.com.
EB5, what is it?
Help, H-E-L-P.
Awesome. EB5help.com. Yeah, that's an amazing thing. That is so interesting that you purchased that. That is, different. I've never talked to anybody who's done that before. That is an amazing concept for me. So I'm sure all the listeners are very interested in hearing that. I think it's a great option. So it's something definitely, and it provides, especially in a market like this, you guys the ability to provide investors and potential investors an opportunity to really make money. So as you stated, when you're doing your 3 options, like that is a significant advantage that you have on the marketplace, that you can create income for your investors. So, kudos to you. That's an awesome thing that you've done. And that is definitely the way it shows that you are looking outside of the box, different from the norm. As we kind of discussed, anybody can go in and say, oh, I'm going to add a dog park over here to this multifamily. We're going to add some in-house laundry. We're really going to make a bunch of money. We're going to cut expenses. Like, everybody can do that. right?
Yeah.
That's not, there's nothing creative really about that. And that's, these fluffy performas, but that doesn't really impact. That's just, a bunch of fluff and nonsense. This is a real way to actually guarantee you can have a good upside and you can beat the market.
Absolutely. That this and land, that's why our focus, as I was in the bank, I tell this story many a times. When I had the vision for creating the company, it was about creating divisions of the company like the bank, right? So when your bank has the mortgage division right now is having less transactional elements to it, but the credit card division might be humming and hawing, right? So then your
Credit
revenue,
card division's humming.
yeah, it is, right? So, but at the end of the day, if, bank's top line revenue and bottom line revenue, because it has multiple divisions, becomes more predictable, and they don't have to necessarily do transactions for the sake of transactions if they only have one tool in the toolkit. So that's how we created it, right? Multifamily was, from our standpoint, great when we could buy it in 2020 at at a great price. But buying it in 2023, all things being equal, it's very hard to get value out of a value add property that's been value added 5 times versus us versus us doing a land project, which is a reverse value add. So we don't even buy the piece of land until we've added value and significantly increased the price before we bought it. Or this type of construction project, selective construction project, by looking at EB5, making sure the land is qualified and bringing in cheaper capital so we can have more of more of the profitability on our side rather than a typical syndication is. That's what we are focused on.
I agree 100%. I think that what you're doing is definitely has a lot of advantages in the marketplace, especially in the current marketplace, and diversifying, as you're saying. Obviously, when you're getting those different revenue streams, when one kind of tapers back like the multifamily has, you have to have other streams and other avenues to make money. If you're just depending on the one and the only one thing that you've learned or can do, then you're kind of stuck right now buying bad deals, right? Because there are no good deals. When you listen to a guy like that, Ken McElroy says he's gone through 2,000 deals and bought 2 in the last 2 years. There's not a lot of good deals out there.
There you go.
So, all right, let's go through a little bit of the land, as you've brought up a couple of times. So, I'm a builder. I love land. So I love looking for land. Land is all I think about. What can I do with this piece of property? How could I put something together here? So walk me through a typical land deal for you guys. What does that look like?
Yeah, so our typical land deal is we find a piece of land that has something going on. So first of all, it could be on the border of a great town, right? So it's right outside the town, but it's on the border. It could have water and sewer right outside, but not on the piece of land. And it could be most likely be, zoned rural or residential, which is the lower density zoning, right? So those three make the land parcel, the retail price of the land parcel as of now, pretty cheap. So we don't lowball. Let's say we buy a piece of land like that, 20 acres for $300,000-$400,000. Now we don't outright buy it. We tie it up under contract for 12 months, 9 to 12 months. And in the meantime, we sink in $50,000 to $75,000, let's say, which is our sunk cost on that piece of land to, for earnest money deposits, hiring attorneys, rezoning applications, civil engineers, etc. And the whole intention during that time is to obviously do the due diligence, physical due diligence, the political due diligence. And the outcome that we are hoping for is to get this land annexed into the town, right? So that adds value because now you're accessing the town's schools and the town's fire department, police department. Get that water and sewer easement from the next door neighbor. So now you have access to water and sewer, which you previously didn't. And then the last piece, which is a significant piece, is to then change the zoning and density from rural or residential to, townhomes or apartment complexes. So in this case, if we get 250 apartments approved on that 20-acre piece of land, combined with water and sewer, combined with the fact that now it's in the borders of the city because it got annexed, that value of that land went from 300 plus or $50,000 to $1.5 million, $2 million, right? And so it's typically 3 to 6x what we are buying it for. So the great thing about this is, if we don't get successful with the rezoning part, at most we would have spent 50 grand on it, which is our sunk cost. But if we get successful, the day we pay the seller $300,000, that day itself, that land is approved or appraised for $1.5 million to $2 million. So now we're working with the developer to sell it, or if it's an EB5 qualified land, we would build on it. There's multiple exit strategies on how far you want to take the land beyond just having paper lots, as it's so called, approved on it, because you now have to go through permitting process. You can disturb the land, put up the utilities, and the value of the price would keep on going higher as you kind of go through that phase of construction. But we typically don't take that risk. We want to leave the meat on the bone for the developer to go through all that, and we sell at whatever that market price for a paper lots is to other developers. 4 out of 5 parcels will sell, 1 or 2 projects will keep that are EB5 qualified and build on it. So that's our most lucrative risk versus reward arm. And we're actually creating a land fund for it. We're raising about $10 to $15 million just for that. And we're looking to do at least 50 transactions in the next 5 years of this kind on just the land side.
That's awesome. All right. So when you say an EB5 approved land, could you let somebody know what does that mean? So if, let's say somebody their family has a piece of property and, maybe it fits some of this criteria that you're talking about, or they have an opportunity, maybe they want to be like, well, we can get this over to you. This fits exactly what you're talking about.
Yep.
How do they know if it's an EB5 approved piece of land?
Yeah, so first of all, disclosure, our EB5 center is only approved for the Carolinas. So anything outside, you have to talk to the EB5 center that works.
Well, this is the Carolina Commercial Real Estate Connection.
There you go. There you go. But I'm sure your audience is all across the US. But it's as simple as there's multiple interactive maps out there. One of them is IIUSA. So if you as simple and as free as going to the IIUSA interactive map and typing in your land address, and it'll pop up and say it's EB5 rural or EB5 TEA green light. That means that piece of land as of this month, based on the US rules, that is qualified for obtaining EB5 funds on it, essentially.
Awesome. And so just so people understand, I just want to kind of back up a little bit for people that aren't as educated as you in this stuff. So when you're finding this piece of raw rural land, right? So you're close, maybe it's zoned, residential, farmland, whatever. It's right on the edge of town. It's got utilities close, maybe on a neighboring property. That's what's appealing to you guys. And what you're doing, in essence, is taking that land and you're going through the rezoning process, right? And that rezoning process can take anywhere from 6 months in some areas to a year in others, right? Depending on what hurdles you have to go through. So you have to meet with the planning department and kind of go through and get everybody to buy in on it, get approval from everyone. Then you get a rezone approval. Then at that point, you're still at a point where the land needs to be entitled for whatever you want to do on it. Okay. So what Hemal is doing is selling it at that point to the next buyer, which is normally going to be a developer that's looking for that. So Hemal's out finding the great pieces of property, doing all the legwork that then a developer is going to want to pick up, then go get that land entitled, and go ahead and do all the flat underground work and get it pad ready for a builder. So it's basically it's a 3-step transaction. So he's finding the raw land, creating value in that land by rezoning it for a higher and better value use. Then he's selling it to a developer who's then entitling that for a certain amount of multifamily units or retail or whatever is the best use. And then he is getting the pads and selling those to end builders who are then building and selling it to the end user. So, I mean, you know, you're the first leg in the process. And if you're out finding these deals, you're what's creating a pipeline. And really, I 100% agree with you pursuing this, especially in this market, because what's going to happen is with these rates going up, there's going to be a large bottleneck of slow down in development because things don't work. So once the boom turns back around, let's say in whether it's 2, 3, 4 years, there's going to be such a backlog and such a need for development. It's going to be overwhelming because things are going to continue to tighten up and slow down. So I think this is a great plan. So man, we've gone through, you've got so much going on. It's ridiculous. I got to go back to the beginning of my notes here and see what else we're looking at. All right. So, all right. So then do you do, so some of them you're saying you also take through the construction project, the construction process. Could we look a little bit on and understand how you guys work with that? So let's say it was an EB5 piece of land. And you've gone through and done the rezoning. Then on those you select, maybe you go through full entitlement. Is that right? So
yeah. It depends on the, again, to your point, it depends on the market and the pace, right? So we can either just do the rezoning. Most of the times we do the entitlement as well. Many a times we can put the road. And we have a piece of land here in Marvin, North Carolina, which if investors know, that's supposed to be the richest town in North Carolina as a town, 270,000 average household income. And so we found the last 43 acres of land there. And we negotiated a contract to get it subdivided. But we are going to put the road and the site work there. And we're partnering with a custom home builder because this is an exclusive gated community gold mine of a, next to country clubs type of piece of land. So the whole point is we can sell at different stages depending on the risk versus reward and the market space that we are seeing. And because we have that flexibility of the cost basis being so low, it allows us to make those decisions on a land by land basis to understand which direction disposition would make the most sense, or wait it out, or build more on it, or go through the next step, etc. So if we are doing the vertical construction, for example, we would sell that piece of land to our construction arm, tap our investors out on the land side. Now we have another 506c construction project going on where they're investing into that project, knowing that this is an EB5 stack. So it'll be, lending or senior debt, then some EB5 money, and then some of their money. And that's how they actually are investing in the construction project, not on the land entitlement project. So we want to make sure that we have a clean set of investors that understand what the land project looks like and get out of that. And then construction is its own different set of investors.
Oh, that's awesome. Yeah, so that's great. So then you're flipping it 2 different ways, which helps because otherwise it's too long of a carry for an investor, because they're not getting payouts. It's not like you're buying, a cash flowing property where they're getting checks every month. So these people are investing in. So you're making sure to turn the one out to start the next one. So they're not sucked in so long so they can realize some profit. Something that you tapped on that I want to kind of circle back. So other people who are thinking about, maybe they can try and find land, something that you said that is something that we didn't really discuss yet, but I think is very critical for people that if you're looking for pieces. So you found this 43 acres. Something else you can do to create value that you just touched on was subdividing the property. So understanding that, you could maybe get this 43 acres, subdivide it, sell off one portion of it, and get almost all your money back. And then you have basically a zero cost basis, let's say, and you have half the property, right?
Yeah, that's what exactly that parcel is. What we're doing is we are keeping 3 5-acre lots for ourselves, right? Because again, it's Marvin, North Carolina, best public high school in the Charlotte MSA, only gated community in that town that this will be. So having 5-acre lots itself is a significant value to us. And then selling those other 20 lots that we have subdivided, to your point, partnering with a custom home builder that makes $5 million North Carolina homes to make some homes there. And that would make an incredible return for our investors and ourselves on just the 20 lots. Plus we get this bogey of 3 lots that we were keeping 15 acres.
This is going back to this creative thinking, this Hemal. You're knocking it out of the park for everybody. So you're making minds blow out there. You've got all the tricks of the trade, which are what makes successful people in this, is kind of always thinking outside of the box. You can follow one path that everybody follows, or you go down a different path. You can go when the market's great and jump in with everybody, or do like the smart investors is you slow down when everybody else is jumping in, and then you start to jump in when everybody else is getting out of the way.
Yeah,
right.
Exactly.
So awesome. Well, Hemal, thank you so much for joining us today. I think we've gotten a wealth of knowledge from you, so I appreciate you sharing everything. And if people want to reach out to you and get maybe on your investor list, or reach out and find out more about what you're doing, what's the best way to catch up with you and your team?
Yeah, our company is Sage Equity, so sageequity.com. And my email address is Hemal, Hemal, at sageequity.com. And they can reach out to me. I love to talk about real estate, and love to talk about any of these creative options. And if you have any parcels of land or looking at other creative options, I'm happy to give back to your investors if they're listening to and thinking about any of these aspects to go into and deep dive into. I'm happy to help.
Awesome. Again, thanks so much, guys. I really appreciate you joining us, Hemal, and hopefully we can get you back someday in the future. Thank you so much.
Yeah, thank you. Thank you so much for inviting me.